This is a platinum bar. 1 kilogram of the densest, rarest, most industrially critical precious metal on Earth. Platinum is 30 times rarer than gold in the Earth's crust. Its melting point exceeds 1700 degrees Celsius. Its catalytic properties are irreplaceable in chemical processes, ranging from petroleum refining to pharmaceutical synthesis. For decades, the platinum market operated on a simple assumption. Supply comes from South Africa and Russia, demand comes from automakers and jewelers, and the price balances the two. Simple, transparent, predictable. That assumption just collapsed. At 3 a.m. Eastern on Tuesday, an obscure filing appeared in China's State Administration of Foreign Exchange database. The document, published in Mandarin with no English translation, no press release, no analyst call, disclosed that the People's Republic of China has accumulated 220 metric tons of platinum in strategic reserves. 220 metric tons. Convert to troy ounces, and you get 7.07 million ounces. Compare to annual global production of 5.5 million ounces, and you realize China has stockpiled 15 months of global mine output in a reserve that nobody knew existed until Tuesday morning. The filing was categorized under Strategic Material Holdings, alongside rare earths, tungsten, and antimony, metals China controls and weaponizes for geopolitical leverage. Platinum just joined that list. And the market that priced platinum as if supply would flow freely wherever demand existed is about to discover what happens when a strategic power decides that flow should stop. Here's what they're not telling you. China's platinum stockpile wasn't accumulated overnight. The filing discloses holdings as of December 31, 2025, but footnotes reference Strategic Accumulation Program initiated Q3 2019. 6 years of buying. 6 years of removing metal from global circulation. 6 years that nobody in Western markets noticed. How did China accumulate 7 million ounces without moving the price? The answer reveals a strategy so sophisticated that it deserves study by anyone who thinks they understand commodity markets. China is the world's largest platinum importer, consuming approximately 2.2 million ounces annually for jewelry, industrial applications, and automotive catalysts. That import flow was visible. What wasn't visible was how much of that import flow went to consumption versus how much went to strategic reserves. Chinese customs data shows platinum imports averaging 2.4 million ounces annually since 2019, roughly 200,000 ounces per year above apparent consumption. That excess, 1.2 million ounces over 6 years, accounts for about 17% of the strategic reserve. The remaining 83%, approximately 5.9 million ounces, came from sources that didn't appear in trade statistics. At 7:30 a.m. Hong Kong time on Wednesday, Reuters published an investigative report tracing China's platinum accumulation. The report, citing unnamed sources in the refining industry, identified 3 primary channels. First, domestic recycling. China processes approximately 800,000 ounces of platinum annually from spent auto catalysts and industrial scrap. Historically, this recycled platinum entered global markets through Hong Kong and Singapore. Starting in 2020, export permits for recycled platinum became increasingly difficult to obtain. The metal stopped leaving. It accumulated domestically. Second, Russian supply. Russia produces approximately 650,000 ounces of platinum annually, primarily as a byproduct of nickel mining at Norilsk. Since Western sanctions began in 2022, Russian platinum has been redirected to non-Western buyers. China, through intermediaries in the UAE and Kazakhstan, has reportedly absorbed most of this flow, approximately 2 million ounces over 4 years, at discounts to global benchmark prices. Third, African offtake agreements. China has signed long-term supply agreements with platinum miners in Zimbabwe and smaller South African producers. These agreements, structured as development financing in exchange for guaranteed supply, diverted an estimated 1.5 million ounces from the open market since 2019. Recycling capture, Russian redirection, African offtake. 3 channels, operating simultaneously, invisible to Western market participants who track NYMEX and LPPM data, but not Chinese customs filings or African project financing. The accumulation was hiding in plain sight, if you knew where to look. Most analysts didn't know where to look. This is where the lie becomes unsustainable. To understand why 220 tons of Chinese strategic platinum matters, you need to understand the platinum market structure, and why that structure makes it uniquely vulnerable to strategic manipulation. Platinum supply is the most concentrated of any major commodity. South Africa produces 72% of global output, approximately 4 million ounces annually, from mines concentrated in a 300-kilometer arc called the Bushveld Complex. Russia produces 12%, 650,000 ounces, primarily from Norilsk nickel operations in Siberia. Zimbabwe produces 8%. The remaining 8% comes from scattered sources globally. Two countries, South Africa and Russia, control 84% of platinum supply. Both face structural constraints that limit production response to price signals. South African mining is in crisis. Electricity load shedding, rolling blackouts lasting 8 to 12 hours daily, has reduced mining productivity by 23% since 2019. Labor costs have increased 67% over the same period as unions extract wage concessions from mines that can't afford to strike. Ore grades are declining as easily accessible deposits deplete. Anglo American Platinum, the world's largest producer, announced in November that it was closing 4 shafts and reducing output by 400,000 ounces annually. Impala Platinum followed with 200,000 ounces of cuts. Sibanye-Stillwater cut another 150,000. South African platinum production is contracting, not expanding. Higher prices won't reverse the decline because the constraints are structural: electricity infrastructure, labor dynamics, geological depletion, not economic. Russian supply is sanctioned. Western buyers can't legally purchase Russian platinum directly. The metal flows through gray markets and intermediaries, but the friction adds cost and uncertainty. More importantly, Russia has every incentive to redirect platinum to China rather than Western markets. China pays. China doesn't impose conditions. China offers a strategic partnership that Western markets can't match. With South African supply contracting and Russian supply redirected, the marginal source of platinum for Western markets is recycling, and recycling depends on end-of-life vehicles being scrapped for their catalytic converters. That flow is steady, but cannot increase rapidly. You can't create more 15-year-old vehicles to scrap. Into this supply-constrained market, China has introduced a 7 million-ounce stockpile, metal that was absorbed from global circulation and is now held for strategic purposes. The stockpile doesn't have to be used to affect the market. Its existence changes behavior. Traders who might short platinum must now consider that China could release supply to crush their position or withhold supply to squeeze them. The strategic overhang creates uncertainty that the market cannot price. At 11:15 a.m. London time on Thursday, the World Platinum Investment Council published an emergency market assessment. The document, unusual in both its timing and its tone, stated that the disclosure of Chinese strategic holdings fundamentally alters platinum market dynamics and requires reassessment of supply-demand models. The WPIC's reassessment showed that apparent platinum deficits since 2019, deficits that had puzzled analysts who couldn't identify the demand-absorbing supply, were explained by Chinese strategic accumulation. The demand was real. It was state demand, not market demand, flowing into vaults rather than end-use applications. The reassessment also showed that with 220 tons now held strategically, global above-ground platinum stocks available for market distribution have shrunk dramatically. The WPIC estimates freely available platinum inventory, metal not held by ETFs, not in Chinese strategic reserves, not committed to industrial users, at approximately 1.8 million ounces, 4 months of global consumption. A razor-thin buffer against any supply disruption or demand surge. Less than 60 days remain before the hydrogen economy reaches an inflection point that could transform platinum demand. Hydrogen fuel cells require approximately 30 grams of platinum per kilowatt of power output, roughly $1,000 of platinum at current prices for a 100-kilowatt fuel cell stack suitable for heavy trucks or buses. Toyota is launching commercial hydrogen truck production in July. Hyundai is expanding fuel cell output by 300% this year. China, yes, the same China holding the strategic reserve, has mandated 50,000 hydrogen fuel cell vehicles on the road by 2027 as part of its hydrogen economy roadmap. The hydrogen applications are just beginning, and China has positioned itself to control the platinum supply that the hydrogen economy requires. They accumulated the reserve while platinum traded at $900 to $1,100 per ounce, prices that seemed normal at the time, but look like strategic bargains in retrospect. While one side stockpiles, the other side awakens. The Western response to China's platinum disclosure is taking shape, and it reveals how unprepared the West was for resource competition. At 2:30 p.m. Washington time on Thursday, the U.S. Department of Energy announced an interagency review of critical mineral supply chains with emphasis on platinum group metals. The announcement came hours after the SAFE filing became public, a reactive response to a 6-year Chinese strategy. The review will take 6 months. China's stockpile exists now. The asymmetry in strategic timing is stark. The European Commission convened a similar review, announcing urgent consultations with South African producing nations regarding supply security. The consultations will produce agreements eventually that might secure supply, eventually, for applications that need platinum now. Japan's Ministry of Economy, Trade and Industry reportedly contacted Toyota, Honda, and other automotive manufacturers to assess national platinum stockpiles. Japan holds approximately 400,000 ounces in industrial reserves, 1/18 of China's position. The gap in strategic preparation is enormous. At 6:45 a.m. Sydney time on Friday, Anglo-American platinum shares opened 14% higher on the Johannesburg Stock Exchange. The market is pricing in what strategic stockpiling means for the remaining non-Chinese platinum supply. It's more valuable because it's more scarce, and it's more scarce because 220 tons that the market thought was available is actually locked in Chinese vaults. The price response is just beginning. Platinum traded at $1,087 before the disclosure. It's now trading at $1,244, a 14% move in 3 days. If the market fully prices Chinese stockpiling and its implications for available supply, analysts estimate fair value between $1,800 and $2,400 per ounce. This is what strategic resource accumulation looks like when it's finally revealed. China played a 6-year game while Western markets played quarterly earnings cycles. China accumulated metal while Western producers focused on cost-cutting and dividend payments. China built strategic leverage while Western analysts debated whether platinum was overvalued at $900. The accumulation is complete. The disclosure is made. The market is adjusting. The strategic position is established. China now controls sufficient platinum to satisfy its domestic needs for hydrogen fuel cells, auto catalysts, jewelry, and industrial applications, regardless of global market conditions. They can weather any supply disruption because they've pre-positioned supply. They can accelerate their hydrogen economy because they've stockpiled the catalyst material. They can pressure Western manufacturers by threatening to withhold recycled platinum exports that the West needs but doesn't produce. The 220 tons isn't just a strategic reserve, it's a strategic weapon, capable of being deployed to advantage Chinese industry, disadvantage Western competitors, and reshape a market that assumed free trade in platinum would continue indefinitely. Some will look at the Chinese stockpile and see normal state behavior. We'll assume that every nation maintains strategic reserves. We'll trust that markets adapt and supply will flow to demand at some price. These are the same voices that dismissed Chinese rare earth accumulation until China restricted exports and prices spiked 10x. That dismissed Chinese cobalt strategy until Chinese companies controlled 70% of global processing. That assumes strategic commodity competition is a theoretical concern rather than active reality. Others will recognize what 220 tons in Chinese vaults actually means. That 15 months of global production is now unavailable to the open market. That the apparent deficits since 2019 were real deficits absorbed by a state buyer. That the freely available inventory is now 4 months of consumption and shrinking. The informed are not predicting that platinum will hit $2,000 or $2,500 or any specific number. Strategic stockpiles can be deployed to suppress prices as easily as to elevate them. China could sell to crush Western investment demand and buy back lower. What the informed recognize is that the market structure has fundamentally changed. A state actor with strategic intent now holds dominant inventory in a metal critical to the energy transition. This is not financial advice. This is not a recommendation to buy platinum or platinum miners or fuel cell stocks. This is simply a description of what was disclosed on Tuesday morning and what it reveals about a market that thought it understood platinum supply and clearly did not. 220 metric tons, 7.07 million ounces, 15 months of global production, accumulated over 6 years, disclosed in an obscure filing at 3 a.m. Eastern. The secret reserve isn't secret anymore. The strategic position is established. The market is just now beginning to understand what it means. China accumulated while platinum was cheap. China disclosed when the position was complete. China now waits while Western markets scramble to understand a game that ended before they knew it was being played. 220 tons, the number that changes everything about platinum, and nobody saw it coming.